Hi, welcome back to another episode of Wilkin and Gutton Plans, the Balance Sheet Breakdown. Today on the Balance Sheet Breakdown, we're going to be talking about the importance of accurate financial reporting for startups. I'm Chris Frederick, a partner with the firm, and joining me this month is the lead of our client accounting and advisory services, our CAS department, Juan Arana. Juan, thanks for joining this month.
Chris, thanks for having me here.
So Juan, right, I think what we always see is when a startup is being formed, the first thing they do is financial reporting and making sure that the accounting is set up, right?
All the time. 100%.
100% of the time. I think what it kind of comes down to is what are people passionate about, right? People don't go into business because they want to do accounting, right? People go into business because they're passionate about that kind of underlying product, right? And I think a lot of what we're going to be talking about today, and I think it's something that we do quite a bit in our CAS department, is the accounting and bookkeeping for startup tech companies.
And I don't blame them. I mean during the early stages, the focus is your product, and trying to get money in the door so you could monetize that product. So accounting is probably the last thing on their mind. Yeah.
Right. I think setting a little bit of a roadmap for where our conversation is going today. Mm-hmm. We'll talk about what we see. We'll call it that kind of pre-seed round. That's maybe personal investments, friends and family. Really kind of proof of concept, and what are some of the struggles have been as companies maybe transition to that second stage, which is, hey, getting there. Maybe it's your first institutional investor, your first private equity money, like that real chunk of money that maybe really propels the company into the future. And then from there, hey, there's round 2, there's round 3, there's exits, but those two, I think, are where there are kind of two lines in the sand where we see changes in what we see for financial reporting and some of the struggles companies have with it. I think let's start talking about companies just getting going, right? Yep. So I'm an investor of an idea that I have, and I'm gonna personally fund my startup. Yep. $50,000 just to get me going, yep, right? Yep. So fine, I've incorporated. Now what?
Yeah, sure. Yeah. So let's assume that the incorporation already happened, and they had their conversations with their lawyer, and that's all in place.
Yep.
So I think it's very important right off the bat to open up a bank account and separate your personal finances from the corporations. And a lot of startups, especially in the technology space, they do incorporate instead of forming an LLC or a partnership. A second thing is credit cards, corporate credit cards. In that startup space, there's a lot of companies out there that issue corporate cards instead of your traditional American Express, right? Because the underwriting for American Express is different for a startup. They have the revenue. There's really nothing, yep. The underwriting is different. So getting credit cards out there, you got to start your payroll. You got to make sure that is in line as well. So I think the foundation is, and the most important thing is, bank account, setting up a bank account for the company.
You started a business, let's run it like a business.
Right.
For sure. And there's a lot of technology out there that to help get this done. I think we don't really see many companies that show up to us with the proverbial shoebox full of receipts and bank statements, right? That banks have technology, things like QuickBooks Online exist, things like Divvy, Ramp, that there's a whole lot of technology that can be implemented that's relatively inexpensive that really can go a long way in taking some of that stress off the back end, right? And so payroll, when I think about payroll, credit cards, bank accounts, I think our first questions are, what's the basis of accounting, right? And so what do we maybe normally see with those companies just kind of getting going?
Yeah, so I would say cash basis.
Yep.
Early stage companies, one of the first things they need to report on is cash burn, and how much runway you have with that cash until you run out of money. And you need to go to your next investment round. So I would say cash basis, and you're gonna want to try to pick a basis, right? Because cash basis is just cash going out the door, right? But now you have income tax cash basis, which follows specific rules that everybody reports on, or you have uniform financial statements instead of just saying, okay, I report on cash without really following anything.
I feel like that's the most. One of the things that we see companies get tripped up the most of, is they don't follow anything consistently, right? So it's, we're cash basis, but, I prepaid a year of insurance, so I want to show that as an asset.
Right.
Well, listen, when you're maybe that early stage company, it matters a little bit less what you pick, because maybe nobody's harping on your financials as maybe they are in the later rounds. But I think our strong recommendation is you got to pick something and you got to be consistent. When we, as we get involved in these companies, I think that's really action item number one.
Correct. And then we ask, hey, do you have anything in place? Do you have QuickBooks Online in place, right? That's the preferred general ledger software.
It's inexpensive,
right?
User-friendly. When you start with zero, right? When as a company is formed, the onboarding process is pretty seamless, right? It's a bit of work if you go to a service provider 2 years in and say, hey, I've got nothing.
Correct.
I've got 2 years of bank statements. I've got 2 years. You can go on and we can all get the online data and export it in Excel from my bank. That's all I've got, right? Like that's a bigger mountain to climb, right? I mean,
and a lot of the times, when you come with a year and a half worth of data, it's more expensive to just get caught up and get cleaned up that having it set up in the first place.
Right.
It's very straightforward to create a QuickBooks Online company. It's very straightforward to connect your bank account and start automating the accounting. And we got a lot of the founders, they're not accountants, right?
Yep.
There's usually an operations, there's usually the person doing the programming and the R&D. And they're not, accountants. But if you, speak to a professional, set up an account, fairly inexpensive, and have a conversation on how about you can keep tracking the transactions, picking up basis of accounting, it will save you money down the road.
Well, I mean, listen, and it's not only about money, right? I think thinking about some of the pitfalls, some of the struggles we've seen companies have. If you're not maintaining in something your books, how in the world can you comply with your year-end filing obligations? Whether it's 1099s, which are due 30 days, 31 days after the year ends. It's not just, oh, well, hey, my tax preparer needs it. I'll take the extension. It's not due till, October. You've missed a lot by then.
Yeah. Our recommendation is, set up QuickBooks Online, start coding the transactions, have a conversation with an accountant, an outsourced accountant about the basis of accounting. Start looking at what your compliance is, right off the bat. If you don't have financial reporting requirements to your investors, you're going to have to, you're going to have to report on taxes. So there's deadlines that you should be aware about, and it could be, income tax compliance with the IRS or with the states. It's a little too early on to talk about sales tax because we're talking about pre-revenue companies.
We're talking about just getting a company set up.
Then we have 1099 reportings at the end of the year, right? Everybody that you issue $600 or more that provides a service, technically you're supposed to issue a 1099. This is a very high level definition,
right.
But that's
right. You have to at least make the assessment. Same thing with the thought of am I a W-2 employee or am I a 1099 employee, right? It's easy to issue those 1099s. It's maybe a bit more cumbersome, like you mentioned, to get that payroll set up day one.
Another thing to think about is once you issue your shares that you want to have, authorized, you have a pool option for your employees. Once you start granting those shares, there's other legal requirements that you want to start thinking about and having conversations with your lawyers, and one of them is an 83B election, and that you technically allow your employees to make an 83B election to save them on taxes, and that needs to be done. Assuming you allow that, that needs to be done within 30 days of when the shares, the options are granted to the employees, and they're normally RSAs, restricted stock.
Right, and that can happen throughout the year, right? So if you issue shares in June, hey, you might not be talking to your accountant or your attorney by the time your 30-day window is expired, and so when I think about some of these early stage companies, those are the problems, right? Is it's hey, fine, if you don't track every dollar where you spent it super contemporaneously, okay, we can catch that up.
Yeah.
But I can't make up if you're late with every tax deadline. We can't just throw it in QuickBooks and pretend that the 1099 W-2 issue doesn't exist. And I think that's some real examples that we've seen, right? Is that, companies call us a year to 2 years into their life cycle, and we're asking some of these, maybe more fundamental questions, and the answers aren't great.
Yeah, have some founders, not reached out to us for 9 months, and then were we able to, get them caught up and make sure that they filed everything timely? Sure. So, you don't have to have everything in order. It's best practice, and it'll for sure make your life easier. And you have it good right now because During the pre-seed, your investors are normally not institutionalized
Yeah.
investors, right? And what that means is that they're not investing somebody else's money, so they don't have to follow that many rules.
Right. There's a little less pressure.
Correct. I mean, and you can have in pre-seed
Yeah.
rounds some institutional investors, and it just speeds up the accounting, and
Yeah.
you need to formalize everything a lot sooner.
Transitioning to that first round of Series A outside investor, due diligence uncovers a lot, right? And so the last thing you want to do is, hey, have this great product, have buy-in from somebody on the technological side, and be tripped up because, oh, hey, I'm not in compliance with these handful of items. Which I'm not suggesting that being out of compliance is a deal breaker. It's just another hurdle
Yes.
to work through that a little bit of prevention would have mitigated.
Yeah, I would say after you get your seed money, after the seed round, you're going to have to start reporting more on your financials. All right,
Yep.
and it really depends. The level of reporting depends on who is your
Right.
investors.
And how much, right?
And how much.
I think we've seen, if that first seed round is on the smaller side, there's a lot more flexibility, right? We've seen negotiations for what that reporting might look like.
Yeah, 400, 500,000.
Yep.
It's different than 3 million to 5 million, which it can get up there in the
Yep.
in the pre-seed rounds. But after that, you're going to start your reporting. So that's when you really want to start having conversations with your accountant and say, look, here's my books on a cash basis. Here's what my plans are. Let's say a year and a half, you want to go for your seed round. And that's when people are going to start really looking at your books. It's not so much about the idea. It's not just
Right.
the idea.
It's not just the idea anymore.
It's, hey, what have you done with the money that you received?
Right.
Where are you? So you want your financials to be accurate. You're still on the cash basis of accounting, income
Right.
tax
'Cause
cash basis.
cash burn's still important at this
Yep.
point, right? We're not talking about companies that have a product they're selling. We're talking about companies that are, chewing through the investments to have this great product. What are you spending the money on?
Yep.
It's not personal dinners, right? It's not.
Yeah.
Let's get the ship pointed in the right direction.
Yeah. So once you start talking to, the seed round, that's usually when the VCs come in. That's when the reporting kicks in and we see the basis of accounting might change. And the VCs or your investors will start looking for more accrual
Right.
or even GAAP, semi-GAAP financials.
Right. That's what they're used to seeing. They're used to understanding. Hey, not what have you spent, but also what do you owe. And it's around this time that I think we start to see minimum viable products for tech that maybe start to be sold. So we start thinking about revenue.
Correct. And I mean, once our clients come to us and they're saying, look, I'm going to do my seed, and here are the agreements that are on the table, right? I'm going to have to choose from the various investors. Hopefully they did their homework and they can select their investors. That's how they negotiate. But they come to us and saying, look, the lead investor wants quarterly GAAP financial statements. Can we do that? And usually they come without notes.
Right.
There are certain things that we can negotiate, and we can say, look, your revenue recognition, it's very immaterial right now. We can get an understanding of what it's going to be, but do we have to apply full revenue recognition when it's
Right.
immaterial
It's
to the
immaterial,
financials?
right? You've got one customer with minor revenue, but hey, GAAP means a lot, right? GAAP means complete understanding and calculation for stock compensation expense over the term of these agreements, as opposed to as they're exercised, right? And so,
Right.
It's and I think one thing that I think a lot of people don't realize is that every aspect of agreements are negotiable, right? That just because your VC says, hey, we always take GAAP statements and we always take them quarterly. How about once a year for the first 3 years? If hey, what our build-up process is going to be.
Right.
Compliance with some of these obligations in investment contracts, don't have to be the material determinator, so to speak, of your financial reporting, right? That yep, that's the direction they want to go. But hey, is there a middle ground that we can settle on?
Correct, and I think at this point it's crucial that you definitely have an accountant in place, somebody that understands your industry and somebody that really understands the different bases of accounting that you need to follow.
What we look at and we call cash to accrual or cash to GAAP conversions mean a lot. So let's maybe focus on cash to full GAAP,
Yeah.
right? Technology capitalization means a lot. There's a lot of different paths you can take that determine what the capitalization points are.
I think 99% of the time this happens where you start having conversations with a founder about GAAP, and then we say, okay, here's what your product is. Here you start, you're going to start selling. Are you a software as a service, or are you selling a technology license?
Yep.
And there's different rules. Most of our clients fall under the software as a service, the SaaS. But once you fall under that SaaS, an accounting rule is that you have to capitalize your software development cost. And the rules on how to capitalize the software development cost is different. It's different if you're a SaaS, if you sell SaaS, or if you sell a license. And the rules that you have to follow when you're software as a service is you have to follow the rules for capitalized software for internal use. And that term is very, very confusing to founders because they're saying, I'm
not using this.
Yeah, I'm selling this product. Because the other rule is capitalization rules for software costs when you're planning on sale, lease. So it's very confusing, and they really don't understand that. And we have to sit down and spend time with them and say, look, forget the name. This is the rule that you have to follow.
Well, and so what's different about the GAAP conversion, right? It's not just, I need to convert today, and from here forward, I'm capitalizing. No. GAAP conversion, you have to be considerate back to day one.
Yeah.
Right. I think that's a bit of a stumbling block that we've seen a number of companies encounter. Right. It's, hey, I've been cash because I've been doing it by myself in the evenings and it's been fine. Now somebody wants accrual accounting. I've signed the dotted line. They've given me, like you said, my $5 million investment. I don't know if I have those invoices from 18 months ago when I was cash only. But I maybe crossed the line for capitalization requirements, right? It can get a little hairy.
It can, and to make things more complicated, it's very difficult to keep track of the certain stages that you have to follow in order to capitalize software. And it's an area of difficulty where currently the FASB understands that it's an area of difficulty, understands that there could be misstatements of financial statements, even if somebody's following the rules, because of agile development and the way things are being done now than before.
Right. It doesn't take 10 years to develop one product, and that one product you sell for a decade.
Right.
It's
so even if we have these conversations from day one, it's very difficult to measure some of these things and account for them correctly. So that's why it's important to have the conversations with your accountant along with your investors to say, look, we're going to expense all our R&D costs instead of capitalizing. I think that's a lot easier said than done if you sell a license than a SaaS startup, because the majority of SaaS startups do need to capitalize something. But that's the perfect conversation that you have where you might be able to get away with certain things. Now, once you start going through your A rounds, your B rounds, when you require full GAAP, that's when you really got to turn the notch.
Or let alone if they're audited.
Yep.
Right. I mean, it's that's when having all the documented policies and procedures really becomes important, because hey, not only do your investors want to see that, your auditors want to see that. Right. And what that means, and if there's instances of non-compliance, what does that look like? How does that get corrected? And ultimately, right, I think we've seen some examples where I might think I'm selling a SaaS. I've got everything written up as though I'm selling a SaaS. Under audit, founder's opinion doesn't hold up.
Yeah. I think this year we had a client where they started selling a new product. They started having conversations with their auditors, and then during those conversations about the new product, something came to light about what they're currently offering, and a light switch went. It's like, oh, we might be doing this incorrectly. And they had to go back and restate some financials. Yeah,
for sure. And that's just it. It's nobody was being nefarious, right? All the information was on the table. The auditors had been there for years, and but it's just, hey, new information has come to light. I didn't ask the question. I think especially as companies really grow and get into the revenue producing mode, you get your own internal accounting departments. They're obviously disconnected from the technology itself, and so hey, how can the accounting department get the information they need to be able to make the right the right calls without upsetting the apple cart, right? Because we understand and appreciate the importance of it, right? That's what we live and breathe. But I don't think I know that's not maybe how every person feels.
Right. And I think it's also important to understand what your accountant or your outsourced accountant or accounting firm is good at. I think when it comes to startups and the technology space, it gets specialized. So you really want somebody that knows what they're doing, right? And this specific example, this client, they came to us, right? They hire us as a consultant saying, hey, our auditors want to change the way we recognize revenue. Do you agree? Can we make an argument?
Right.
Can we make a case to stay the same? And the way that the auditors were proposing was to recognize the revenue sooner. But they've been doing it a certain way for years, and it'll make their accounting a little more complex. They want it to stay the same.
Right. They said, hey, this is what we really think we're selling. Fine, we understand there might be some nuances that make us not fall in that bucket, but can we make an argument, right? Because, like you said, with the capitalization of startup, within some of this technology specifically, some of it, becomes an art, not a science, right? Our tax department has kind of the running comment where you ask a tax question and the answer is, well, it depends, right? And so I feel like for SaaS companies, for technology companies, licensing companies, that applies.
Yeah. So I would say, after you get, to summarize, after you get the seed money, you start looking more into accrual, GAAP financial, especially once you're gonna get your seed, right? And then once you get that seed, that's when it kicks in. So you want to start having conversations with your accountant about accrual and GAAP financials, what it takes. Use them as consultants to negotiate, and not even to negotiate, just to make sure you don't sign something
that you don't understand.
And it's going to cost you thousands and thousands of dollars to do, where it could have been a conversation with your investors, but you know what, let's cross that out.
Yep.
These financials that you have this way are fine.
Right.
And the areas I would say to really discuss with your accountants are revenue recognition, if those sales start happening, but assuming you're still pre-revenue, that capitalization of software development costs. Yep. Stock compensation is an area that it gets complex in the accounting world. So, you got to think about you receive your pre-money, your pre-seed, that's normally convertible debt safe. Then once the seed round happens, all that converts into preferred stock. And then the additional money that comes in from outside investors also converts it to preferred stock. That's some difficult accounting, the conversion. So you want to talk about that. In terms of other areas of accounting, I think that's
for sure. And I think I think there the big takeaway is, hey, having that really clean cap table, understanding what you've got, where it is, and you mentioned technology a few times, right? So thinking about takeaways. Yep, the cap table is important, and it's always important, right? Whether it's accounted for under cash basis, GAAP, having an understanding of where your authorized shares are or aren't is really important, whether it's exercised or not. But again, circling back to technology, you mentioned it, right? There's a lot of technology that even from day one can be implemented to take some of the burden off of the shoulders. Yeah. And we're not talking about huge investments of capital to get some of the technology integrated and talking to itself.
Yeah, absolutely. I mean, one of the first technologies to look at is QuickBooks Online. You're going to have to figure out your financial institution and all that stuff. Yep. A lot of, before SVB went down, all our startup companies and clients were using SVB. Now everybody went to the bigger banks.
Right, but they all have a nice implementation with QuickBooks Online.
They do.
There's a number of different things that can be used to facilitate payment of bills, which also then can act as your back office filing cabinet to keep track of all those invoices. So a few years down the road, when you're ready for more robust accounting, a different basis, hey, the support exists, and you're not chasing it around. Yeah,
absolutely. I mean, once you select your general ledger software, whether QuickBooks Online or Sage Intacct, we see QuickBooks Online being the most popular. Yep. You want to have your accounts payable in place, and there's technologies out there that will cut a check for you, and you can issue ACH through these platforms. They connect to your bank account. So you have to look at this as you're enhancing your accounting process. It's not more about just reporting and compliance. It's how do I make this automated? How do I make everybody's life easier?
It allows you, as in those early days as the founder, to focus on
correct
on what you want to, while also not totally bypassing the accounting
Yeah, and to give some of these founders some names, DV, Bill.com are some platforms that you could use. Ramp is a platform. Brex is a platform that has bill pay. And another area where we see efficiencies being gained is around corporate cards and corporate, credit card spending. There's companies like DV, like Ramp and Brex, where they automate this whole process. And you can issue corporate cards, you can give it to your employees, you can use it for expense reimbursements, and it's automated. And all this syncs with your accounting software. And the costs for these platforms are a lot of times free because the way they make their money is, with swiping.
Right, like credit card transaction fees. And to me, that's the takeaway. This does not have to be a huge investment to get something in place to get pointed in the right direction.
Correct.
Juan, I feel like that's a great spot to wrap it up. For the month, and that's kind of the big takeaway is that there are technology solutions that exist. Something that we see and help implement really about every day within our cast group.
Yeah, absolutely. I would say that we get excited when founders come to us and saying, "Hey, here's where I'm at in the stage of my company. Can you guys help?" And when they see that it's just not about compliance and reporting, how we can help and automate and make everybody's lives easier,
right.
That's really
right. That's where it really starts to make a whole lot of sense. And so, thanks for joining us on another episode of Wilken and Gutton Plans and Balance Sheet Breakdown. I'm Chris Frederick, where we try to help you.